Welcome, everyone, to the Keys to Home Buying podcast, where home buyers of all kinds come to learn the ins and outs of buying a home from industry insiders who know it best. I'm your host, Justin Mead, mortgage loan officer, and today is episode 3, where I'll be discussing closing costs. So, a lot of first time home buyers already know what a down payment is. It's the money you need to bring to the table that's kind of your purchase of a portion of the home up front. So, if you're going to put 5% as your down payment, as soon as you close, you already own 5% of that house at a minimum. All right, so that's down payment. 99% of first-time homebuyers know what a down payment is and expect it. About 25% know what closing costs are. So I wanted to have a whole episode where we talk about them because I don't want you to be caught off guard going into buying your first home, not knowing about these things, because they can get pretty pricey depending on the home and where you're buying. At least in Vermont, they're a little bit higher than a lot of other states. So we want to make sure that you're prepared. So closing costs are essentially one-time fees to pay for the services of buying a house. So we're going to go through each of these kind of one at a time and break down what they are. So right out of the gates, we've got lender fees. Now, any lender that you go to has underwriters that they have to pay for, overhead for their locations, whatever, just kind of general operating costs. And to cover those costs, they have lender fees. In general, they're broken out into underwriter and doc prep fees is how they'll be listed on your loan estimate. All right, so let's pause here. A loan estimate is something you receive at the beginning of the loan process. Its counterpart is the closing disclosure, which you receive at the end of the process. In the loan estimate, it's going to give you a rough idea of what your closing costs are, and it'll itemize what they are and then give you an estimate on how much they cost. At the end, on the closing disclosure, it tells you exactly what they are and exactly how much they cost down to the penny so that you know how much you need to bring to the closing table. So on that loan estimate, under the lender fees, you'll see typically underwriting fees and doc prep fees. On average, at least in Vermont, we see these roughly around $900, depending on who you talk to. I'd say give or take $100 to $200. So that's the lender fees. Now, beyond that, the only all the other fees are non-lender related. So when you are shopping around for a mortgage and you hear, hey, this lender has less closing costs than another lender, be skeptical. Ask a lot of questions. Ask for that detailed estimate breaking down exactly what their costs are, and then compare it to that other lender and see where the differences actually are. Because 9 times out of 10, our closing costs should be the same as the closing costs for lender B down the street, right? Now, there is a caveat. There are other fees that can fall under lender fees, and they're called discount points. So this is when, let's say 9 times out of 10, you pay points to lower your interest rate. That's what discount points are. So think of it as, say the interest rate without paying anything is 6%, but you'd feel more comfortable at 5.5%, and it costs you another $3,000 at closing. All right. Now, first of all, if you're working with the right lender, they're going to calculate what the break even on that is. And by that, I mean, okay, if you pay $3,000 and it's going to save you X amount of dollars per month, how many months of saving that X dollar amount is it going to take you to recuperate that initial $3,000 investment? If that's within a length of time that's reasonable or within your goals, go ahead and do it. If it's not, if it were me, I would say don't do it, right? So the points 9 times out of 10 are to lower your interest rate. Sometimes, and this is that other 1 time out of 10, depending on your situation, what loan program, what credit score, what property type, occupancy type, all the stuff we talked about in the last episode that goes into an interest rate, sometimes the entire rate sheet that we can offer, even the highest interest rate, will come with some form of points. So what that means is, okay, maybe you have to pay just to get an interest rate. Now, in that scenario, if you're shopping around, one lender is charging points and another is not, that's really the only realistic that lender has cheaper closing costs than the other scenario. Otherwise, there's just something else going on and you need to dig deeper. So points are when you're paying more to lower the rate. Sometimes you have to pay points just to even get a rate, but that's rare. Then the other side of that is you can sometimes take a higher interest rate and get what's called a lender credit. That lender credit can be applied towards your closing costs so that you have to bring less to closing. Now, the way that works is in that same scenario, if the 6% rate doesn't cost anything, maybe you take 6.5 and you get $3,000 towards your closing costs. Don't hold me to these numbers because it's going to be different for every scenario. Each rate is priced a little bit differently. We're just kind of using figures to visualize it to make this a little bit easier to understand. So in the lender fees section of your closing costs, that's all that should be in there. Doc prep, underwriting, and then we've got the points or the lender credit. If you're getting some specialty product like a bond loan or a renovation, you might see some other fees in there. But for today's purposes, we're going to keep it simple and say this is just like a conventional purchase of a primary residence. All right, so moving on from the lender fees, we're going to get into the other ones that pay for other services outside of the mortgage. So next, we've got the appraisal fee. So anytime you're purchasing a property, again, 9 times out of 10, we require an appraisal on that property. We, the lender, are going to order that on your behalf. So it's nothing you have to do. You just have to be prepared for the fee. These days in Vermont, those are averaging around $1,000 per report. And I believe I touched on this briefly in a prior episode, but the appraisal is going to tell us 2 things. 1, the value of the home. And 2, if there are any health or safety concerns with the home that need to be remedied before you close. So you'll hear this come up if you're working with a realtor and you're looking at a property that's a bit of a fixer-upper, or maybe it's a foreclosure and it's got, some damage to it. If you're trying to submit an offer that is not conventional, the listing agent might look at that as not an ideal loan because of the appraisal. What I mean by that is appraisers on certain types of financing have to look out for more things than with others. So if it's a conventional loan, they're going to be a little more lenient when it comes to health and safety versus a government loan. All right. And I won't get into the specifics of that today. That's a good topic for another episode, as we can dive pretty deep on that. But just know, if you're looking at a bit of a fixer-upper, if you're using government financing, it may be looked on as less of a strong offer than somebody with conventional. All right, so we've got the appraisal fee, about $1,000. That's going to tell us health and safety concerns and the value of the home. We order it on your behalf, so nothing you have to worry about. The next couple items are actually really minor, but they're still required. So fee for running your credit report. I believe today it's about $68 per report. You're only going to get charged if you move forward with getting a mortgage. So if you're just getting pre-approved, you don't have to worry about paying that. But once you're under contract, then we'll hit you for it at the closing table. Flood certification to make sure you're not in a flood zone. That one's really cheap. I think it's about $7. And then there's this thing called the tax service, just to make sure all your taxes are in order. That one, I believe, is about $70. So some pretty minor fees in the grand scheme of things, but still it's something you can expect on your loan estimate. The next section is lumped into attorney's fees. So if you're listening and you're in a title state, this could be a little bit different, but more or less they operate roughly the same. So in Vermont, we use attorneys, and what they do is they do a title search on the property where they go back 40 years in the land records to make sure there's no outstanding liens on the property or anything out of the ordinary that would put you as the buyer at risk once you own the property, right? To do that, they charge a title search fee. And then what they also do is facilitate closing. So they have another fee for that. And in general, these days, they too are roughly $1,000, maybe $1,200. And most attorneys just charge the same thing. Call around, see who makes a good fit for you to work with. If something does come up, you want to make sure you're working with somebody that you jive with. And that's the funny thing about working with attorneys is ideally you're not talking to them as a buyer until you're at the closing table. And if you hear from them, it's usually a bad thing. So you're kind of knocking on wood that you don't hear from the attorney during the process. So they're $1,000 to $1,200 somewhere in there. Something else they do that's not their fee, but they facilitate it, is they purchase this thing called lender's title insurance. Now, with title insurance, there's 2 versions. One is an owner's version, one is a lender's version. The lender's version is required. The owner's version is optional. Now, what title insurance is, first of all, I would say reach out to an attorney to get an in-depth description of exactly what it is and what it does. And when you're buying a house, just ask your attorney if it's something they think you should get. But essentially, it covers you if after closing something was missed during the process or missed in the title search. And now Joe Schmo down the street can come up with this piece of paper and say, hey, actually, I own this, not you. This insurance covers the attorney's fees to remedy that issue after you close on the house. So as the lender, we require that it be purchased to cover us. And then you as a buyer, it's optional if you want it for yourself or not. On the lender's side, I honestly don't know the exact calculation, but from what I've seen, it's a little over 1% of the loan amount, I believe, that gets charged. And then for the owner's title insurance, same thing. I don't know the exact calculation, but from what I've seen, averages about maybe $350 for that fee. So again, reach out to your attorney to get a more in-depth explanation of what it is and if they think it's something you should get as a buyer. The next thing we're going to talk about is recording fees. This might run you $300, and it just gets someone down to town hall to update all the land records to say, hey, let it be known, Joe and Schmo now own this property, right? They just update the land records, and there's a fee per page that they're updating. Plan on maybe $300, somewhere in there. The next one is the big one that's Vermont specific, but no matter what state you're in, there could be a version of this, and it's called transfer tax. So the Vermont state transfer tax, if you're buying a primary residence in Vermont, is going to be 0.5% for the first $100,000 of purchase price, and then 1.45% for every dollar above that. So it can add up pretty quickly the higher above 100,000 in purchase price that you get. So that's a big one that, especially if you're moving here from out of state, it catches a lot of out of staters off guard. If they are used to buying in the state they're from that might not have any transfer tax, now they come to Vermont. Holy cow, this is a huge fee that I wasn't prepared for. That's why I said at the beginning, Vermont has most of the time higher closing costs than other states. So it's good to be aware of this. Now, the good thing about this transfer tax is you only pay it when you purchase. So if you were going to refinance down the road, you wouldn't have to pay it again. All right. So that's transfer tax. Now, if you're buying an investment or a second home, it's a flat 1.45% for the entire purchase price. But if you're going to use like a down payment assistance program such as VHFA, I'd have to look up what their program allows for, but it's a cheaper transfer tax. I believe it's 0% up to the first 110,000 of purchase price. And this is where I'm not totally sure. I think it might be 1.35% for every dollar after. If you're interested in learning about that, give me a call. We do work with VHFA. That's a great down payment assistance program for first-time homebuyers. So if you're interested in learning more, definitely reach out. I'd be happy to chat and look into that further for you. So that's transfer tax. The rest of the fees are technically called prepaids. So you might hear, if you're talking to realtors or other people in the industry or even friends of yours that bought, they might refer to it as closing costs and prepaids. To me, I just call it all closing costs because it's not your down payment, but it's money due at closing. It's just a little easier to think of it as one lump sum rather than breaking it out even further when it's already confusing enough with everything that's going on in this process. But technically, it's closing costs and prepaids. So this next section we'll talk about are the prepaid items. So the first one is going to be your prepaid interest. Now, today is January 16th. So if you were to close today, you would actually pay interest on the home for the January 16th through January 31st, which I think would be 16 days if you include today. Math could be off, but either way, let's call it 16 days of daily interest. So we're going to take what the monthly interest equivalent is going to be, divided by the days in the month, multiply it by however many days, 16. Now you're going to pay that up front. So if you close today, January 16th, 2023, your first mortgage payment isn't going to be until March 1st, 2023. That's a big thing to keep in mind as a renter, because when you pay rent, you pay on the first for that current month. When you get a mortgage, you pay on the first for the prior month. So it's a bit of a benefit almost. If you're looking at it from just how much am I going to pay this month versus next month versus the one following. Sorry, I got tongue twisted there. Then yes, you kind of skip a month in a payment, because if it's January 1st, you're paying rent. February 1st, you're not paying rent and you're not paying a mortgage. March 1st, you are paying a mortgage. So in theory, you don't make a payment in February. Just keep in mind, you still are paying for February, right? Because you paid January's rent and you're paying February's mortgage. You're just not paying it until March. But it's still kind of nice in day-to-day budgeting. You do kind of skip a payment. So that's pretty nice. Keep that in mind as you're buying a house. All right. So the first prepaid is that prepaid interest. The next one is going to be your homeowner's insurance. We require that you pay the first 12 months of homeowner's insurance up front. So we collect all 12 months there. On average, I would say guess about $780 if it's a single family home as an annual insurance amount, which is about $65 a month. Now, depending on what's in the home and where it is, and those are the big ones. Proximity to a fire station, that'll all factor into what your insurance premium will be. Talk to an insurance agent to get a better idea for yourself. But in general, I usually average about $65 a month, which is about $780 a year for a standard single family home. You prepay the first 12 months. Now, this is where people get a little tripped up, because then once you're paying monthly, part of that monthly payment is your insurance payment. So now people think they're getting double charged. It's not quite how it works. So before we get into the rest of the prepaids, let's talk about that, because they'll tie into one another. So when you're making that monthly payment, a portion of it is your homeowner's insurance. That portion is going into an escrow account. Same thing with your property taxes. We're going to collect some at closing, and we'll talk about that next. But in your monthly payment, we take the monthly equivalent of those property taxes and we put it into that escrow account as well. So that money is just building over time. So with the insurance, you prepay the year in advance, then you make a monthly payment. So by the time next year rolls around, there are 12 months of homeowners insurance in that escrow account, and we pay for that new year out of that escrow account. So you're not double paying, you're prepaying, hence the term prepaids in this. When it comes to the escrow, if you were to pay off the mortgage, sell the property, and most of the time refinance that loan, you're going to get whatever's in that escrow back as a refund. So think of it as more your money that's just sitting somewhere being managed for you. There's no extra fee for it. It just is what it is. And on that note, I don't even know if I would consider this a cost again, which is why it's not considered a closing cost. When we're talking about closing costs and prepaids, this is a prepaid. So keep that in mind as well. So we got the first 12 months of homeowners insurance. Then we collect an extra 2 months of homeowners insurance to sit in the escrow account as a buffer. This buffer is there for maybe you miss a payment, maybe your premium goes up, variety of reasons. It's good to have a little slush fund in case we get to one of your payments and there's not enough naturally. Well, now we have these extra 2 months to help out. With your property taxes, something similar happens. So first off, we do collect an extra 2 to 3 months as a buffer, but the rest of it is going to be dependent on 3 different things. So one, we got to reimburse the seller for any taxes that they've paid for where you're going to be living in the property. So today's January 16th. If the seller has paid property taxes through February, you owe them 1 month for February and then a half month for January, right? Or 16 days, whatever the math ends up being, just like the prepaid interest. Okay, so we're going to collect that. Now, let's say we know that the next tax installment is due on April 1st, and it's going to cover 4 months worth of taxes. Well, we know that your first payment is March. So by the time April rolls around, we'll only have one payment. And that one payment means just 1 month worth of taxes. But we need 4 for when April gets here for that tax installment. So those other 3, we're going to collect at closing. Okay. So now we've got 1.5 months to pay the seller. We've got 3 months to prepare for that first tax installment. And then the third part is what we already talked about, just the buffer in the account. So let's call it another 3 months. So in that case, we're going to collect 7.5. Let's just round it up for the estimate. We're going to say 8 months of taxes we're going to collect up front. When it gets to the closing disclosure, the attorney is going to calculate it again down to the penny and make sure that it is broken out to the 16 days for January. But what I would do in that case, when I disclose the loan to you, is say 8 months, so you're over prepared for that payment. All right. That's escrows and prepaids. That more or less sums up the traditional closing costs and prepaids. Now, the rest of it, when you're looking at an estimate, a loan estimate, you're going to look at the bottom right of the page. And this is, as far as I know, the same layout with every lender. You got the left side has some of the fees, and then the top right has the rest, and the bottom right has a little summary. In that summary, it's going to tally up all the closing costs, and then it's going to give a section for how much of this is financed. So if you are getting like FHA financing, that upfront mortgage insurance premium, that's financed, it's still a closing cost. So you're going to see it itemized on the left-hand column, but then you're going to see it deducted on that bottom right summary because we're going to finance it through the mortgage. Same with USDA, their upfront guarantee fee, VA, if the funding fee is there, that's going to be part of it. So you'll see that portion. Then you're going to see your contract deposit. So the amount that you gave to submit your offer, if it was $1,000, we're going to deduct that there, saying you already prepaid $1,000 of this, so we're not going to collect that from you at closing. If the seller is contributing anything towards your closing costs, that's going to be here. And then you'll have the final total at the bottom right, which is your cash to close. This is going to be inclusive of your down payment and closing costs, everything that you need to bring to closing from this point forward. All right. So in Vermont, I usually use this calculation that you use 9 times out of 10. Again, that's just my favorite, I don't even know the term. I'm drawing a blank. Favorite ratio, I guess. But 9 times out of 10, the good calculation for your closing costs is 3.5% of the purchase price plus $1,000. So if you're buying a $100,000 home and you're putting 5% as a down payment, you got $5,000 for the down payment. And now we're going to do that calculation. So 3.5% is $3,500, and then we're going to add $1,045. So now add that to the $5,000 down payment and round it up just to be safe. We're going to say you need $10,000 to bring to the closing table. So if you're out there searching, you can kind of use that rough estimate to give you an idea of what you can expect for closing costs. Your best bet is to reach out to me, tell me a property, we'll get you pre-approved, and I'll tell you pretty accurately what your closing costs should be based on a general closing timeline. So that about sums up this episode. I hope this was informative. If you want to get a pre-approval or chat about any of this stuff, reach out at jmead@homebridge.com. I hope you have a great day, and we'll see you on the next episode. Bye-bye.